Building a holding company from scratch is one of the most strategic moves you can make to scale wealth, consolidate assets, and create a lasting legacy. Whether you're starting with $100,000 or you already have significant capital, the mechanics of structuring a holding company remain the same. Today, we're going to walk through the exact steps you need to take to build a holding company that grows from $100 million to $500 million. Whether you're serious about wealth architecture and want to understand how the richest families and entrepreneurs organize their capital, make sure you subscribe to the channel because we break down these strategies every single week. First, let's define what a holding company actually is. A holding company is a legal entity that exists primarily to own shares or assets in other companies. It's not an operating business. It doesn't sell products or services directly to customers. Instead, its purpose is to hold investments, manage those investments, and generate returns through dividends, capital gains, and strategic acquisitions. The holding company becomes the apex of your financial structure, sitting at the top and controlling everything below it. Think of it like an umbrella under which all your other business ventures and investments live. The reason holding companies are so powerful is simple. They allow you to separate the operational risk of your businesses from your personal assets and from your other investments. If one of your portfolio companies faces a lawsuit or a major problem, the holding company and your other assets stay protected. This is called liability isolation, and it's one of the primary reasons wealthy people use holding companies. Beyond protection, a holding company also gives you massive tax advantages. You can defer taxes on dividends, optimize the way you pay yourself, and structure acquisitions in the most tax-efficient manner possible. You can also borrow against the assets in your holding company at favorable rates because lenders see a diversified portfolio as lower risk than a single business. Now, let's talk about the size targets we mentioned, $100 million to $500 million. These are meaningful milestones. At $100 million, your holding company has real institutional credibility. Banks take you seriously. You can negotiate with Fortune 500 companies. At $500 million, you're entering the realm where family offices become relevant and you can move markets with your capital allocation decisions. Most holding companies that reach this scale have taken anywhere from 5 to 15 years to build, depending on how aggressive the founder is and how favorable market conditions are. Step 1 is to clarify your investment thesis. You need to know what you're actually investing in. Are you a tech investor? A real estate guy? Do you want exposure to healthcare, consumer goods, or financial services? The holding company is just the vehicle, but the thesis is the engine. Your thesis should answer these questions. What sectors are you targeting? What size of companies do you want to acquire? Are you looking for cash flow, growth, or a mix of both? What's your expected holding period? Are you planning to roll up companies in a single industry? Or are you building a conglomerate with diverse holdings? Clarity here saves you years of wandering and makes every subsequent decision much easier. Step 2 is to establish the legal structure. You'll need to form a holding company, which is typically done as a limited liability company or a C corporation, depending on your goals and your accountant's advice. The LLC structure is simpler and more flexible, but a C Corp can be better if you plan on taking the company public eventually or if you want a more traditional corporate structure. You'll file articles of incorporation or formation with your state, usually Delaware, because Delaware has the most sophisticated corporate law and the most predictable courts. The filing itself costs between $500 and $2,000, and you should have a corporate lawyer guide you through this. Don't try to do it yourself with an online service. The small investment in a good lawyer now saves you massive problems later. Step 3 is capitalization. You need to fund the holding company with initial capital. This capital becomes your dry powder, your ammunition for making acquisitions and investments. If you're starting, you might capitalize with $500,000 to $2 million of your own money. If you have partners or investors, you might do a Series A or Series B funding round. This capital gets converted into equity shares in the holding company, so you own a percentage stake. As the holding company grows in value through acquisitions and operational improvements in your portfolio companies, your equity stake becomes more valuable. Many founders also take a salary from the holding company to cover their own living expenses and to have a consistent income stream. Step 4 is governance structure. You need to establish a board of directors or a board of managers if you're an LLC. This board provides oversight, strategic guidance, and accountability. Even if you're the majority owner and you could technically run everything unilaterally, having a formal board with outside directors brings valuable perspective and credibility. Your board might include an industry veteran, a seasoned CFO, maybe a lawyer, and definitely someone with M&A experience. Board meetings should happen quarterly, and you should keep detailed minutes. This governance structure becomes increasingly important as you grow and as you approach institutional-sized capital. Step 5 is establishing your holding company's financial infrastructure. You need a dedicated CFO, or at least a fractional CFO, who understands holding company structures and consolidation accounting. You need a cap table that tracks exactly what percentage of each portfolio company you own, when you acquired it, what you paid, and what it's worth today. You need quarterly financial statements that consolidate all your portfolio companies into a single holding company P&L and balance sheet. You need annual valuations done by a third party for tax purposes and for your own decision-making. This infrastructure might sound expensive, but it becomes essential as soon as you have more than 2 or 3 portfolio companies. It's the difference between knowing your actual net worth and guessing. Step 6 is acquiring your first portfolio company. This is where your capital actually gets deployed. Your first acquisition sets the tone for everything that follows. It should be a company where you have conviction, where you understand the business, and ideally where you can add value beyond just capital. It might be a company you used to work in, or an industry you deeply understand. The acquisition price might range from $5 to $50 million, depending on your capital base and your ambition. Structure the deal so you're buying the assets or the equity of the company, and then those assets or equity sit on the balance sheet of your holding company. You might pay cash, use seller financing, or use leverage from a bank. Step 7 is operational improvement. Most successful holding company builders don't just buy businesses and hold them passively. They actively improve them. This might mean replacing management, cutting costs, entering new markets, bringing in specialized talent, or implementing better financial controls. The goal is to improve the cash flow and profitability of the business so that within 2 to 4 years, the company is worth significantly more than what you paid for it. This is how you create value and fuel your growth to larger size milestones. Step 8 is establishing a culture of capital discipline. Once you have capital, the temptation is to deploy it everywhere. You have to resist that. Every investment your holding company makes should be in service of your thesis. You should have clear return expectations. If an acquisition doesn't meet those expectations, or if it takes you off thesis, you pass, even if it's offered to you at a great price. This discipline is what separates successful holding company builders from those who end up with a scattered portfolio of mediocre assets. Step 9 is scaling to multiple portfolio companies. Once your first company is humming and producing cash flow or appreciating in value, you deploy more capital into a second, third, and fourth company. This is where you start to benefit from portfolio diversification and network effects. Your CFO now manages multiple cap tables. Your board now oversees multiple business lines. The complexity increases, but so does your optionality. You're no longer dependent on a single business performing well. By the time you have 4 to 6 portfolio companies, you've built something that looks like a real holding company, not just a single investment. Step 10 is tax optimization. This is where you bring in specialized accountants and tax lawyers who focus on holding company structures. They help you understand the differences between C Corp and S Corp elections, when to trigger capital gains, how to use debt strategically to offset income, and how to structure distributions to yourself and to outside investors in the most efficient way. Tax optimization at this stage might save you hundreds of thousands or millions of dollars annually. It's the kind of investment that pays for itself many times over. Step 11 is investor communications if you have outside capital. If you raised money from limited partners or other investors to capitalize your holding company, you need a regular cadence of updates. You should be reporting on the performance of each portfolio company, the health of the overall portfolio, and your capital deployment plans. Transparency builds trust and makes it much easier to raise additional capital later if you need it. Step 12 is creating a clear exit strategy. You don't build a holding company hoping to go bankrupt. You build it with an end game in mind. That might be selling the whole thing to a larger company or a private equity firm. It might be taking it public. It might be passing it on to the next generation as a family office. Whatever the end game is, you should have that vision clear because it informs decisions you make at every stage. Some holding companies are built to be sold within 10 years for multiples of what you put in. Others are built as century-spanning family enterprises. Know your target. Step 13 is expanding your deal-making network. As you grow, you'll become known in certain circles as someone with capital and conviction. Deal flow will come to you. You'll hear about acquisition opportunities before they're widely marketed. You'll get access to entrepreneurs who are thinking about selling their companies. This network is incredibly valuable. Nurture it. Host dinners, speak at conferences, invest in adjacent founders. Your deal flow quality often determines your investment returns more than anything else. Step 14 is building operational leverage. Once you have multiple companies, you can centralize certain functions. You might have a shared HR department across all your portfolio companies, a shared legal and compliance team, shared insurance arrangements, shared IT infrastructure. This reduces costs and improves efficiency across the entire portfolio. It's one of the reasons holding company structures can be so profitable. You get economies of scale that a single standalone company couldn't achieve. Step 15 is thinking about leverage strategically. Most holding companies use debt thoughtfully. You might get a credit line at the holding company level that lets you make acquisitions more quickly. You might use recourse debt secured by the assets of your portfolio companies. You might have seller financing where the previous owner finances part of the sale price. Used correctly, leverage amplifies your returns. Used carelessly, it creates existential risk. The key is to match your debt maturity to your expected cash flows, and to make sure you maintain adequate liquidity even if something goes wrong. Step 16 is tracking your progress against milestones. You have a goal of 100 million to 500 million. Create clear mile markers. At 25 million in portfolio assets, celebrate that win, but also ask what needs to change to reach 50. At 50 million, do the same. At 100 million, you've hit a major milestone. You now have institutional credibility and access to capital that wasn't available before. From 100 to 200, the process becomes more sophisticated, but also more automated. From 200 to 500, you're managing complexity at a scale where every small percentage point of operational improvement compounds into millions of dollars. Step 17 is managing concentration risk. As your holding company grows, you need to make sure no single portfolio company represents too much of your total value. A common rule of thumb is that no single company should represent more than 40% of your total portfolio value. This ensures that the failure of one company doesn't bring down the whole enterprise. It also forces you to think about asset allocation in a sophisticated way, much like an institutional investor would. Step 18 is staying connected to your core thesis. As you grow, it's tempting to drift. You see a great opportunity in an industry you don't know. You meet an amazing entrepreneur in a sector that's adjacent to your thesis. You start making exceptions. These exceptions often underperform. The most successful holding company builders stay disciplined about their thesis, even when they're big enough that they could do anything. They say no to a lot of good deals because they're waiting for great deals that fit their thesis.